Hi, this is Tony Sagami for Uncommon Wisdom Daily. This week I want to talk to you about computers. One of the mantras I've been repeating for the last decade is that you do not want to own stock in any American company that has to directly compete against a low-cost Chinese competitor. When it comes to investing in computers, you really have three main choices: Dell, Hewlett-Packard, and Lenovo. I think that one of these three has an extremely bright future, while the other two may eventually end up in the same group as Commodore, Atari, K-Pro, NEC, and Tandy. You remember those names? Now, all Americans are familiar with Dell and Hewlett-Packard, but not everyone is familiar with Lenovo. This Chinese company got its start back in 2005 when it bought IBM's personal computer division. Lenovo has grown like a weed since then, and it just keeps getting bigger and bigger. Now, Lenovo just reported its third quarter results, and they were fantastic. It posted a profit of $144 million. That's an 88% jump from the same period a year ago. And revenues grew to $7.8 billion in one quarter. That's a 35% year-over-year increase. What's interesting about that performance, even though Lenovo is a Chinese company and it's number one in the Chinese market with a 31% market share, its blowout quarter was primarily due to really strong sales in the U.S. Meanwhile, Lenovo has grown its market share from 11% last year to 13.5% this year, according to Gartner Research. Now, during that same time, Dell's market share has fallen from 12.2% to 11.6%. Now, that means that Lenovo is now the world's second largest computer maker, ahead of Dell, and just slightly behind Hewlett-Packard, which is number one with a 17% market share. But I doubt it's going to hold on that position for much longer. Now, in addition to its strength in the PC market, Lenovo's new ThinkPad tablet looks like it may become one of the strongest competitors for the Apple iPad. Now, Lenovo stock is traded on both the Hong Kong Stock Exchange under the ticker 0992.HK, 0992.HK, or you can buy it in the over-the-counter market here in the U.S. The ticker is LNVGY.PK, LNVGY.PK. That's right, Lenovo shares are just as easy to buy as Dell or Microsoft or Boeing or any other American shares because it's here in the U.S. And don't let all that anti-China rants that are coming from Washington, D.C. turn you against Lenovo. Why? Because it's moved its executive headquarters and innovation center to North Carolina. This is one Chinese company that's actually creating American jobs. Now, I'm not suggesting you rush out and buy Lenovo stock tomorrow morning. As always, timing is everything. So you need to do your own homework or wait for my buy signal in Asia Stock Alert. However, I will say that when it comes to the computer market, investing in Dell or Hewlett-Packard would be a big mistake because of the intense, low-cost competition from Lenovo, as well as a global title shift to tablet computers. In fact, you need to evaluate every American stock you own for its exposure to China. If you have shares in a company that has one or more major Chinese competitors, you need to sell it. If it has little future as American companies that used to dominate the furniture, steel, automotive, electronics industries found out. On the other hand, some American companies have turned China in one of their key growth strategies, and they're making big, big bucks over there. I'm talking about companies like Yum Brands, Tiffany's, and Apple. Even if you don't own a single Chinese stock, China is going to have a huge impact on your portfolio. Until next time, this is Tony Sagami for Uncommon Wisdom Daily signing off.